Welcome to Inside Out, a podcast deep diving into the insights behind Equifax data. I'm Carrie Cheung, Head of Insights at Equifax. It's no secret that the construction industry has faced significant challenges over the past few years, and insolvencies remain at historically high levels. However, Equifax data suggests there might be green shoots emerging from some segments of the building and construction sector. The pace of construction businesses entering external administration slowed last year, but only for those with more than 5 full-time staff. We've also seen key financial metrics of companies generating revenues of more than $10 million slowing stability or improvement, and more mid to large construction businesses have seen an improvement in credit quality. Now, the news isn't so good for smaller construction operators. Businesses employing fewer than 5 full-time staff continue to report higher number of external administrations, lifting the overall construction businesses' failure rates to record highs. Joining me today is Brad Walters, Head of Product and Rating Services at Equifax, to explain what's driving these trends and what they mean for the construction industry. Brad, thanks for being here today. So, are we finally seeing a turnaround in the building and construction industry?
Thanks, Carrie. Yeah, I think the data and particularly the leading indicators are actually showing us some very positive signals, which is good. But it's important to note that we have come through a very challenging period. And I think it's fair to say that all the listeners on today's call will know the construction industry has certainly faced a barrage of challenges. We've spoken before about the cost escalation that they've had to weather, but there's been numerous challenges ranging from, labour and material constraints, logistics disruptions, and that's really elongated. It's extended the build times. And so as a result of that, businesses have really had those delayed cash flows and at lower margins. And so that's played out both in terms of the exit rates we've seen previously, as well as the insolvency numbers. So, the exit rates at decade level highs and the huge ongoing increases in construction insolvencies in prior periods. And so it's fair to say that when we came into the pandemic, the whole industry was certainly feeling the pressure. But fortunately, due to a range of temporary insolvency protection measures and relief mechanisms, we actually saw a reduction in the number of construction insolvencies. And so we went down to about nearly 40% of, historical levels across construction insolvencies. But where we are today, we've certainly played catch up. We've overshot. We're 3.7 times where we were in 2021, and we're 2.3 times higher than pre-pandemic levels. So we've certainly seen and experienced that significant uptick in insolvencies in construction. And that's important for the economy because construction is a key driver of growth. And we know that for every dollar spent in the construction industry, it reflects effectively $3 across the broader economy. So it has an important part to play. But of all the sectors across the economy, construction is one of the most impacted over the last 5 years when you look at insolvencies. Second to only hospitality. So that's when we're looking at hotels, accommodation, cafes and restaurants. But construction's also typically quite overweight in its representation of insolvencies. And so pre-pandemic, sort of at 17, 18% of all insolvencies came from construction, whereas it's 1 in 4. So it's closer to 25%. So it's certainly overweight in terms of its representation of insolvencies. But there is good news. And the good news is that we actually have seen a real moderation in the construction insolvencies more recently, and notably in the March 2025 quarter. So that's really encouraging. But importantly also around the credit quality metrics. And so when we look at businesses operating in the construction industry and we look at the underlying fundamentals, we can see that play out in terms of their credit ratings. And credit ratings are a measure that are provided by regulated and licensed agencies like Equifax, Standard & Poor's, Moody's, Fitch, that provide that forward-looking insight in terms of the capacity and the willingness to honour their commitments. And so what we do is we typically look at how do the credit ratings change over time, and are they improving? Do we see an improvement in the credit quality? So are there credit rating upgrades? Or conversely, do we see deterioration and a credit rating downgrades? And this time last year, we're actually reporting that we were seeing, in terms of the preceding 12 months, so for 2023, we're seeing twice the number of downgrades to upgrades. Twice the number of downgrades. So it's not a healthy position for an industry sector. And so, we've seen that play out in terms of the insolvency rates. But where we stand today is that we've really seen that turn around. So not only are we seeing a slowdown in terms of the rate of increase of construction insolvencies, but we're seeing a change and a shift in the credit ratings. And now what we see is, in fact, a greater level of rating stability across the construction industry. But we're also seeing now 19% of constructors, we're seeing 19% with rating improvements, rating upgrades, more than the number of rating downgrades we're seeing. So some really positive signs that we're seeing at the moment in terms of the construction industry and its outlook.
That's really encouraging. And when you think about the people that rely on, that work in the industry and the implications on the overall economy, that's really the positive news, right, as well. So what are some of the financial trends across the industry and what are the implications for particularly smaller businesses?
Yeah, I mean, Carrie, you were sort of teasing this out, I guess, in your opening comments. And I think that perhaps to give the smaller businesses across construction a bit of context, it might be helpful that we talk first about what are we seeing across the larger businesses, and then we can compare and contrast to what we see at small. But across the larger cohort, and I think you recall you sort of sharing that that's typically those businesses that are generating or have pipelines in excess of $10 million, right, of pipelines and activity is we're seeing improvement across their sort of their credit quality metrics. And so as they've been recycling sort of their project pipelines, they've been able to win new projects at higher prices. And so that's really supporting improved profitability. But we also see that play out in their cash flows, as well as their liquidity metrics. So we're seeing that play out in terms of their cash levels, their working capital positions. So across the larger constructors, we're seeing improving credit quality trends. And that's playing out in terms of the moderation of the insolvencies across that cohort as well. So for those that are employing more than 5 full-time staff, you're seeing a real moderation of insolvencies across that cohort. But we're not seeing the same sort of trajectory for small businesses in the construction industry. In fact, when you look at the underlying metrics, we see that for profitability, cash reserves, working capital positions, we're seeing, in fact, a slight reduction in the median position across businesses in that cohort. And so that's a function of a number of different aspects. But one importantly is noting the fact that it's been a tough environment. There's a large volume of small businesses operating in construction. Invariably, that reflects competition, but also the demand elasticity for changes in price. And so we haven't seen the same opportunity for smaller businesses to be increasing their prices in the same way that larger businesses have to improve the overall profitability proposition. So it's still tough. And again, that's played out in the insolvency numbers for the smaller businesses in construction. So we've seen that real continued sort of strong increase in the volume of insolvencies coming from that smaller business segment of construction.
And I suppose smaller businesses also are open to the more volatile and fragile towards factors like inflation and everything that average consumers are facing as well. So you've talked at a national level overall what you're seeing. What about some of the insights across different states and territories and across different segments across construction? Are they all experiencing the same sort of challenges?
Yeah, there are some nuances across the various states and territories, as well as different subsegments across construction. I mean, talking about some of the states and territories first, New South Wales typically has had, a larger sort of representation of insolvencies than other states and territories, but that's also largely a function of the fact that it's got a large number of businesses in the construction industry that are either originated from, domiciled in, or operate across the state of New South Wales. But over the last few years, we've certainly seen a really strong increase in terms of the number of insolvencies in New South Wales and in the construction industry, sort of leading the charge. And we've seen that sort of follow through across other states and territories. What we've seen more recently, though, and again, looking at sort of the financial year to date for the 9 months to March, we've seen a real slowdown in terms of the insolvency rate of increase across New South Wales. We've also seen that sort of same trajectory across South and West, so South Australia and West Australia of states and territories. But we have not yet seen that really play out across the rest of the eastern seaboard, across Queensland, the ACT or Victoria. And Victoria in particular, looking at the underlying financial metrics behind Victorian construction businesses, we see that generally the median level across various metrics from profitability, cash and working capital positions, the median level of Victorian constructors is generally a little bit lower than the construction industries across other states and territories. So there's some nuances there across, the various states. I mean, Victoria has certainly seen a strong increase for the financial year to date in terms of
Mm,
the rate of increase of construction insolvencies. I think you also asked around different segments across construction.
mm,
And we tend to look at, four main categories across the construction industry. We look at sort of heavy and civil infrastructure as one group. We also look at the non-residential buildings, so commercial construction as another group. We look at residential builders and developers, as well as construction services providers into construction, so construction services as a category. And what we saw coming into the pandemic is that all of those various categories all saw, a significant and material deterioration in their financial fundamentals. But what was encouraging in 2023, we saw for both civil infrastructure and construction services, we saw a real improvement. So a rebound in their sort of their profitability, their liquidity metrics. We didn't see that play out though for commercial construction or resi. But last year was really encouraging. We did see some improvements across commercial construction in particular, and also residential building and development. Not as much, but heading in the right trajectory, which is encouraging. And at the moment, again, looking at residential building construction, again, we look at the median levels across some of those key credit metrics of profitability and liquidity. And across resi, it's still not as strong as what it
mm,
is across its construction counterparts of the various other subsegments across the construction industry.
Mm. So the housing crisis that is often talked about, can you tell me what the knock-on effects on these trends that might have um, on the infrastructure development and housing supply development goals that we've got in front of us?
Yeah, well, I mean, it's been a tough period in construction, and I think
mm,
mid last year we're reporting for the June 2024 quarter. We'd actually been talking about a reduction in the number of credit active construction businesses,
yeah.
and credit active meaning those that are actively trading in the market. They've got trading relationships with suppliers. They're seeking credit. They're active in the market, and that's not a good sign. In an environment where we're really eager to see growing levels of infrastructure and housing supply. But no doubt also a reflection of the fact that we're seeing decade level highs in exit rates from construction and also the significant increase in insolvencies.
Mm,
So that was mid last year. When we look today in terms of what's the financial capacity look like across the various segments of the construction industry, and again, coming back to civil and infrastructure, I think you were talking about infrastructure, we see positive signs there in terms of the underlying financial capacity available across that segment. We also see positive signs across the non-residential building or commercial construction. We don't see the same sort of capacity metrics across the residential building and
mm,
development space.
mm,
And we can point to a number of indicators there, but one is the differential that we see between credit ratings and commitment ratings. So with credit ratings, it's looking at, on a going forward basis, does the business have the capacity and the willingness to honour its commitments in the ordinary course of business? Whereas with commitment ratings, we're looking at for a new project, what's its capacity to service that particular commitment. And generally speaking, we'll see a difference between
mm,
credit ratings and commitment ratings when businesses are embarking on fundamentally different types of project engagements or fundamentally larger types of contracts, or where the new work they're seeking to win through tendering is actually significantly increasing their overall project pipeline.
mm,
And so what we've seen across residential building and development is we've seen that growing divergence between credit ratings and commitment ratings as they're tendering for new work, signaling that they're really looking at bigger projects with larger pipelines without necessarily the same level of financial capacity to support that growing pipeline of work. So really encouraging to see, the residential building and development industry seeking to embrace the needs
mm,
of helping deliver to our housing supply,
mm,
but really not seeing that capacity there. What
mm,
is encouraging, though, is looking at through a lens afforded to us by the Independent Construction Industry Ratings tool, ICERT, we are seeing an uplift in their capability in the residential building and development space. And we're seeing that reflected across a number of measures of their compliance oversights, their corporate governance, the extent of their the controls, the quality assurance programs. So it's great to see the uptick in terms of the capability, but it would be encouraging to see a stronger uptick in terms of the underlying capacity. So hopefully looking ahead, we'll see more credit active constructors in that industry, as well
yeah.
as more financial capacity to support the homes that we'll desperately need.
Right, hopefully. But for now, what does that mean for consumers? Like, will these trends have any impact on your average home buyers?
Well, Carrie, as you know, there's nearly half of all adult Australians have got property intentions in the next 5 years. And looking at that cohort that are really just looking to either build or renovate, we know that 33% of adult Australians are looking to build or renovate, but only 32% have the confidence to move forward. So we have a real confidence gap to fill.
Yep.
We know from a YouGov survey last year that it showed the three big roadblocks for consumers moving forward, buyers, investors, and clients in construction, was concerns around builder solvency, concerns around building quality, and concerns about whether they could trust their building professional or construction partner. Construction as a sector has been long criticised as being, very opaque. There's not a lot of transparency. And again, the data shows that 9 out of 10 clients, buyers, investors in residential building in particular, 9 out of 10 are looking for independent ratings and reference points about their credentials, their capacity, their capability to reliably deliver trustworthy built assets. And so it's great to see in this season where we're seeing more sophisticated buyers and clients of residential homes in that flight to quality. We're really seeing that the role that the Independent Construction Industry Ratings Tool, or ICIRT, is having in terms of really lifting that confidence proposition for consumers.
Yes.
And what we see from the YouGov survey of last year is that across the whole market, only 7% of consumers that are unaware of ratings tools, only 7% reported an improvement in their confidence in construction. So it's not a lot. When you look at the portion of the market that's aware of ICIRT, so ICIRT aware consumers, 69% reported improved confidence in construction. So we're talking from 7% for those unaware to 69% for those that are aware of these ratings tools. So it's providing that really strong, tangible, quantifiable, concrete link about the impact that ratings credentials are having to really lift consumer confidence. And so it's great to see the growing number of rated, reliable, resilient constructors leading the way, really helping build confidence in construction.
Yeah, and it's so important, like for an average Australian, that is one of the biggest investment you have to live in this country. So it's important to be confident and be happy that you're stepping into this investment and in a secure sort of manner. Now, looking ahead, what trends do you expect to see play out in the construction space over the coming months?
Look, it's been tough in construction.
Yeah.
I think we can take encouragement though from the early, and emerging positive signs. So we anticipate that's going to play out in terms of the continued softening of the rate of increase of construction insolvencies.
Yes.
But we'd also anticipate to see that reflecting in sort of a more moderated position of exit rates from the construction industry.
Yeah.
So I expect we'll see that in terms of the 12-month data set through to December 25, but also for the fiscal period in June 2026. So those leading indicators are giving us some confidence and encouragement about how we're likely to see the resilience of the sector improving in the year ahead. Looking across the different sub-segments, I mean, residential building, we've just been talking about that. I think, positive fundamentals. We know that there needs to be a lot more high density apartment as well as low-rise, housing construction completion. So we know that there's a big need, and also supporting residential building as the population growth, the easing interest rates. But we are mindful of the fact that there's still a project feasibility constraint in terms of just seeing how quickly that can accelerate. But the underlying fundamentals for residential building is very positive. For non-residential or commercial construction, it's kind of a bit mixed, but overall we see stability in that segment. And then in terms of the civil, that infrastructure space, more recently we've seen a bit of a slowdown with the staged completion of those, significant projects in the pipelines, as well as the private capex numbers. But, we anticipate the activity levels will continue to track sort of above the long-term averages. So all in all, we're looking ahead at a brighter future for construction with a growing number of rated and resilient constructors leading the way. So I'm optimistic in the year ahead for construction.
That's great. And thank you so much for your time, Brad. It's always great having a chat in this topic, and I always learn so much talking to you. So thank you so much for your time.